When a Japanese government bond sold off in January 2026, most people ignore it. But Bessie, that wasn't just a Japan story, it was a global signal. I'm Nancy Kitty, half the Kitty sisters. We have built nearly $500 million in multifamily real estate, and here's what that bonds move quietly revealed. The global system gets fragile when trust in debt starts to wobble. Japan has spent decades anchoring global interest rates, so when its long-dated bonds spike, that pressure doesn't stay local. It ripples into US treasuries, global currency, capital flows worldwide, and that leads to uncomfortable question investors can't avoid. Can the US carry $39 trillion in debt and a weaker dollar at the same time? A weaker dollar sounds helpful on paper. Exports look cheaper, overseas earnings translate higher, but here's the thing. The US dollar is the world's reserve currency. Foreign buyers don't buy US treasuries out of loyalty. They buy them because they trust the currency, stability, the purchasing power. When that trust wobbles, they don't panic. They demand higher yields. And when yields rise, anything financed by debts gets repriced. That means mortgages stay higher for longer, rent inflation accelerates, asset owners pass costs through, wage earners fall behind. A weaker dollar doesn't rescue households, it raises the cost of capital. That's the part most headlines skip. If you don't own asset in this environment, you're not hedged, you're exposed. Real estate is one of the few assets that adapts here. Rents reset when inflation, fixed rate debt erodes in real terms, repricing costs rise, protecting existing assets. That's not ideology, that's math. While policymakers debate optics, capital is already positioning, and the message is clear. In a high debt, weaker dollar world, ownership isn't optional, it's defensive. Follow us, the Kitty Sisters, your investing besties, breaking down how money actually moves behind the headlines, because wealth isn't built on opinions, it's built on understanding systems and positioning early.